Hello, my name is Suzanne Long, Professor of Accounting at Jackson College, and I'm going to be talking to you about what I call the 6 T's. There are 6 categories of accounts in the accounting system. There are assets and liabilities, and they're like opposite to each other. Assets increase on the left, liabilities increase on the right. And then we've got equity accounts, like capital and stock, and we've got drawing accounts. Capital increases on the right, drawing increases on the left. And then the third set are revenue accounts and expense accounts. Revenue accounts increase on the right, expense accounts increase on the left. All of the accounts in the accounting system fit together in a way. There's a match or an opposite for each one. And every time we do a transaction, we're always balancing. The left side has to equal the right side. If it's a journal entry or a trial balance, we're always balancing out. So I really encourage you to use this sheet. Print it out, have it in front of you while you're working. Each one of these 6 categories is a type. So let's go back to assets. Assets is a type of account, and then over here on the left we've got some examples. Now, these aren't all the assets that you could ever see, but this is a sample of typical asset accounts that you would see in your introductory accounting class. Same thing over here for liabilities. Liabilities is a type of account, and then here's some specific account titles that are examples of liability accounts. Think about what you know about these accounts. Assets, things that we own. Liabilities, balances that we have to pay. Most of these are going to be payables, but look, there's unearned. There are some liability accounts that are not payable. Capital, examples, not too many. It depends on the business type because this is the ownership interest in the business. And drawing, again, not too many. There's just a few different account titles to describe when the owner takes money out of the business. Revenue, there's really not that many revenue accounts. Service revenue and sales revenue are really, depending on the kind of business, what you're going to see. And then there's a few other possibilities. Expenses, oh my goodness, there's so many possible expense accounts. So this is definitely just a sample. There's lots and lots of kinds of expense accounts. So that's just a little bit about the 6 T's sheet. What you're seeing here are the 6 categories of accounts, and you're seeing their normal increase or decrease, depending on which side of the account, depending on the account. The other thing that's looking right at you in this sheet is debit, credit. Debit is left side. The word debit in terms of accounting means left side. Credit means right side. That's it. There's no other meaning to those 2 words. It has nothing to do with banking, has nothing to do with good or bad, and it really has nothing to do with increase or decrease. It depends on the account. For example, let's go all the way down to revenue. When a business records a revenue, they're increasing revenue on the right side, or the credit side. They're decreasing on the left side. Assets, like cash, we see lots of cash in our transactions. Cash is an asset account. Increase on the left side, decrease on the right side. So the whole increase, decrease, debit, credit thing depends on the account. So that's a little bit about the 6 T's and how to use this sheet. I really recommend that you print it and you just have it out in front of you while you're working on the class. If you're working on your accounting class, you've got this out in front of you. It's kind of like a map or a guide. Like you're using Google Maps on your phone to figure out where you're going. It's the same kind of thing. This will help you get to where you're going.